All right, let's dive right in. Today, we're going to tackle a really cool idea, something that I think a lot of investors dream about. Could your portfolio actually send you a paycheck every single week? We're going to explore exactly how some investments aim to make that a reality. Seriously, just think about that for a second. Instead of waiting for a dividend check once a quarter or once a year, you get a steady stream of cash hitting your account every single week. It's a pretty powerful concept, right? And that's exactly what we're going to break down in this explainer, the investment tools designed to do just that. Okay, but first, the important stuff. We've got to be super clear here. This is all for your information, okay? It's not financial advice. All investments, and I mean all of them, carry risk, and what happened in the past doesn't guarantee what's going to happen next. So please, think of this as a starting point. Do your own homework and definitely chat with a qualified financial advisor before making any moves. All right, with that out of the way, let's get into the good stuff. How does this whole weekly investment paycheck idea actually work in the real world? We're going to zero in on 3 specific exchange-traded funds, ETFs, that are built to do just that. And here are our 3 contenders for today. We've got the JP Morgan Equity Premium Income ETF, or EPI. Then there's the Global X NASDAQ 100 Covered Call ETF, that's QYLD. And finally, the SoFi Weekly Dividend ETF, WKLY. Now, they all aim for that same weekly income goal, but, and this is the key part, they take totally different paths to get there. And that leads to some very, very different outcomes. So, to really get what makes these funds tick, we need to pop the hood and look at the engine inside. I mean, generating income every single week isn't some kind of magic trick, right? It's all about the financial mechanics they're using. So, how exactly are they pulling this off? So what we find are 2 totally different engines at work. On one side, you've got EPI and QYLD. They use what's called a covered call strategy. Basically, they own a bunch of stocks and then sell options contracts on them. You can think of it like this. They're essentially renting out the future growth potential of their stocks in exchange for getting paid cash right now. On the other side, you have WKLY. It's a lot more traditional. It just invests directly in companies that are known for paying out really high, really stable dividends. 2 completely different playbooks. Okay, so we've seen the strategies. Now for the part everyone's been waiting for, the results. How did they actually perform? This is where the numbers really start to tell the story and reveal that classic trade-off. How much do you want to grow your money versus how big of a weekly check do you want? This table just lays it all out, plain and simple. And you can see the conflict immediately, can't you? Look at QYLD. It's offering this massive 11 to 12% yield. That's huge. But, and it's a big but, investors actually saw their initial investment shrink by 5% over 3 years. Then you look at the other end of the spectrum, EGPI. It delivered a really strong 25% growth while kicking off a solid yield. WKLI, meanwhile, kind of lands somewhere in the middle. Now, let's visualize this, because a chart makes it even clearer. Yeah, when you see it laid out like this as a bar chart, the difference in capital growth is just, wow, it's stark. EPI is just towering over the others with some really significant growth. WKYLD is in the green too, which is great. But then you see QYLD, and it shows you that its super aggressive strategy for pumping out income came at a direct cost. The fund's underlying value actually went down during this time. But now let's flip the coin and look at it from the other angle, pure income. And just like that, the story completely reverses. This is where QYLD's strategy shines. It delivers the highest yield, and it's not even close. This chart really gets to the heart of the dilemma for you as an investor, doesn't it? Are you all about getting the maximum income you can right now, or are you focused on the total return? That's income plus growth over the long haul. So, okay, we've looked at the different strategies. We've looked at the performance numbers. The big question that's left is, what does all this mean for you? Because there is no single best ETF here, not at all. The right one for you depends completely on what your own financial goals are. And this quote from the source material really sums it up perfectly. It's not about picking a winner, it's about finding the right tool for the job. As it says right here, if you're looking for a mix of growth and income, something like EPI or WKLY might be a better fit. But if your goal is just pure, unadulterated income, then QYLD is built specifically for that. So it really just boils down to these two paths. Path number one, are you seeking pure income? If your absolute number one goal is getting the biggest weekly check possible, and you're cool with the fact that your initial investment might not grow or could even shrink, then the data points towards a strategy like QYLDs. But then there's path number two. Are you looking for both growth and income? If you want a nice income stream, but you also want your investment to have a real chance to grow in value over time, then the more balanced approach you see with EPI or WKLY seems to be the way to go. And that really leaves us with the ultimate question, the one every single investor has to answer for themselves. When you look at your own financial future, what is the right balance for you? Is it getting those weekly payouts today, or is it focusing on long-term growth for tomorrow? Really thinking through that trade-off, well, that's the key to all of this.